Welcome back to The Explainer. Look, today we're stepping away from the daily noise of tech headlines and shiny new product specs. Instead, we're going to put on our value investor hats and look at the AI space by analyzing long-term capital cycles. We're taking a deliberate macroeconomic look at how the fundamental economics of AI data centers are quietly but structurally shifting right beneath our feet. Okay, let's dive into this.
For the past couple of years, the market has heavily priced in one specific bottleneck, right? Raw compute power. But as the very nature of artificial intelligence evolves, we really have to ask ourselves, is the core bottleneck of AI infrastructure actually expanding beyond pure compute? Let's explore this shifting ecosystem together and see exactly how capital allocation is reacting to these new realities.
Section 1. The AI compute baseline. GPUs remain the undisputed engine.
I want to be absolutely clear right out of the gate, just to shut down that whole adversarial narrative. This is not a story about CPUs somehow replacing GPUs. No way. Nvidia and the graphics processing unit remain the undisputed engine for massively parallel calculation, period. AI training and inference still fundamentally rely on massive GPU compute. The market isn't wrong about the importance of GPUs. But as value investors, our job is to look around the corner and figure out what happens next in the value chain.
Section 2. The Agentic AI shift. From model compute to system operation.
Agentic AI is a totally different beast from those early simple chatbots. We're moving way past that basic prompt and response model. These new agentic systems operate continuously. They have to manage incredibly long contexts, reach out to utilize external tools, and orchestrate multiple sub-agents all at the exact same time just to solve complex goals.
It's a very logical evolution of AI workloads. Think about it. We started with basic input and output. Then models started tool calling, fetching data from the web or pinging a calculator. And now we are stepping into full-blown sub-agent orchestration. What this means for infrastructure is that the operational burden has suddenly become vastly more complex.
We are shifting from the compute era, which was highly linear, input, inference, output, straight into the coordination era. Agentic AI hasn't reduced the need for the heavy lifting of raw compute math, but it has massively increased the need for continuous system execution, memory movement, and task scheduling. The bottleneck is no longer just doing the math, it's coordinating the entire workflow.
We're talking about some serious orchestration burdens here. Task scheduling across massive clusters, managing enormous context windows, coordinating memory and data movement, and managing all those tool calls. This stuff is primarily handled by CPUs and the surrounding system architecture. And honestly, this is exactly why the market is beginning to revalue the CPU, not as a replacement for the GPU, but as the absolutely critical anchor of the orchestration layer.
Section 3. Nvidia system-level proof. The core player shifts to orchestration economics.
Nvidia itself is actually giving us the clearest proof of this shift. They aren't just selling standalone GPUs anymore. They're aggressively pushing their Grace Hopper and Vera Rubin architectures, ultra-fast NVLink networking, and complete rack-scale system integration. They are tightly packaging CPUs, networking, and memory fabrics right alongside their GPUs. Why? Because the playing field has officially shifted from the chip level to the system level.
This takes some second-level thinking. We are transitioning away from this pure obsession with single-chip GPU performance to a real obsession with system-level data movement, latency, and power efficiency. Nvidia realizes that if they only provide the calculation engine, the system's overall latency and orchestration will completely bottleneck their chips. Nvidia's strategic actions don't prove GPUs are less important. They prove the orchestration system around the GPU is increasingly vital. Let that sink in for a second. If AI data centers only cared about raw compute, Nvidia wouldn't need to build rack-scale systems or integrate their own CPUs. Their actions totally validate the repricing of this orchestration layer.
Section 4. Repricing infrastructure efficiency. How capital allocation is reacting.
The big hardware giants aren't fighting a zero-sum war to destroy the GPU. They're fighting a war for infrastructure efficiency. Meta is exploring multi-vendor setups. ARM is dominating power efficiency. AMD is taking on massive system integration loads. And Intel is leveraging its massive supply chain. Let's break these down to see the real capital cycle at play here.
Take Meta, for example. Hyperscalers know the AI works. Their core anxiety
Their actual risk when it comes to capital is whether they can scale this stuff at a sustainable cost and power draw. They are heavily prioritizing the economics of power and orchestration over raw, singular speed. If an agentic AI is running continuously, the sheer cost of that continuous operation becomes the most critical metric on the balance sheet.
And then look at ARM. ARM's disruptive threat isn't about outperforming a GPU at parallel math. It's about redefining the data center's return on invested capital, or ROIC, through incredible power efficiency. By providing amazing performance per watt, ARM addresses the power consumption per task. In this new coordination era, power efficiency is exactly what dictates future capital allocation.
There is a massive shift happening in the profit pools. Legacy compute-heavy racks, yeah, they're incredibly powerful, but they have a dramatically different capital efficiency profile compared to new, coordination-optimized systems. When your tasks require constant memory movement and complex scheduling, a balanced orchestration-heavy architecture gives hyperscalers a vastly superior ROI.
And then there's Intel. Intel represents a really fascinating repricing of legacy assets. As the AI stack expands, suddenly things like massive foundry capacity, local manufacturing, and supply chain resilience carry immense strategic weight. The transition from pure compute to system orchestration literally breathes new life into existing ecosystems that can handle complex system assembly.
Section 5. The Coordination Era. A thickening value chain.
We are literally watching a fundamental expansion of what makes an AI data center valuable. Before, we just cared about valuing flops and GPU counts. But now, as agentic AI systems run these continuous, highly complex workflows, the market is suddenly forced to value system orchestration, memory movement, and power efficiency just as highly.
The value chain isn't pivoting away from GPUs at all. It's thickening. The whole infrastructure stack is expanding. Pricing power is starting to distribute outwards into memory coordination and networking. Rack scale efficiency is now just as valuable as chip scale speed. Ultimately, the CPU and the entire orchestration layer are undergoing a deep, structural repricing.
The real story is not that CPUs replace GPUs. The real story is that AI infrastructure is becoming a much thicker value chain. This right here is the absolute core of value investing in technology. Finding the layers of the stack that the market is suddenly relying on, but hasn't fully priced in quite yet.
So, as AI moves from basic model computation to complex, continuous system operation, who ultimately owns that coordination layer? It's a billion-dollar question, and it's one that will absolutely define the next decade of capital allocation in tech.
Just a quick reminder, this content is for educational and informational purposes only and does not constitute financial or investment advice. Always make sure to do your own research before making any investment decisions. Thanks so much for joining me for this explainer. Keep analyzing, and I'll catch you next time.